economically. You think about like a retirement plan. Retirement plan is at most 60 years, all right? In a financial decision, that's 60 years. That's not that long. An SN can be longer, one generation, 150 years or 100 years. Think about urban planners. Urban planners will do 250, 300-year plans for a city. Those are long-term macro plans. There's a guy called Kuznets, sort of like the forgotten economist. He also thought big, macroeconomically. Think about imperial cycle, all right? So this is the American empire. We have been on the peak of the empire for the last 20, 25 years. The last empire before us was the British Empire, the Roman Empire, the Grecian Empire, the Persian Empire, the Chinese, the Egyptians. These are empirical cycles. So you're looking at 100, 200-year periods. So think about how great your vision also needs to be, right? It's not just about stocks, bonds right now. You have to think 200 years. That's a graduate. So I know it's like your clients will say what, but it's about storytelling. So this is about storytelling. What happened? It happened in the 70s after the Bretton Woods collapse, and you don't have to go into stuff. But generally, markets started. People in markets, suppliers and demanders, started deciding what prices should be and not governments. Before that, governments were deciding. IMF, World Bank, Bretton Woods. That's what Bretton Woods agreement is. This sign you see out here, that's the 70s, because the 70s was vital. OPEC happened, an unprecedented volatility. So watch volatility. It's very important. Here's what volatility looked like in the 70s. The first one out here, top left, is the U.S. crude oil prices. And that star shows the 70s, OPEC coming in. And then after that, the 80s. Volatility in the crude oil. Before that, it was flat. To the top right, that is retail price index in England from the 17th century to the 20th century, so 300 years or something. Look what happened from the 70s. From 1780 or something, I can increase it, but you can see it later. That's what happened in the 70s to the price index. Bottom left, same thing, U.S. price index from 1800 through 1990 or something. Look what happened in the 70s. Look at in the U.S. dollar Deutschmark exchange rates after the markets floated. This is the start of the markets, the mid-70s. Everything went haywire. Everything went haywire. Markets became deregulated, the birth of modern capital markets, deregulation. And it was chaotic states, new sets of rules, products, benchmarks. This is when options came into being. Futures and options started in the 70s. Since 1975, it started. And whole new set of benchmarks started showing up. And so this tells us, these pictures tell us what happened in the 70s and the birth of derivatives like credit default swaps. Without it, we couldn't have had managed the economy. All trade would have come to a halt if we hadn't derived facts of risk management. Of course, they were abused. But this economy, this 1970s, the market economy started. And now, after all these years, with these rules and regulations, suddenly that's changed. This has changed, and we need to understand, we need to help clients understand that these are very difficult times for everyone in himself. There's nothing wrong with that. With saying that it's very difficult times to explain. It's a difficult disease. You're going to try your best, but sometimes, some diseases are like chronic. They can't be treated. Now, this new economy showing up, it's showing up in different forms. We used to be a purely market-based economy. Now we are not. We see, typically when markets go down in a down business cycle, weak companies should disappear. Strong companies should survive. And that's the theory of the market, theory of utility maximization. Survival of the fittest. Taking care of me first is utility maximization, survival of the fittest. If a weaker person goes down, I have to survive. so be it. That's the appropriate aspect of utility maximization. So there's no shame in being greedy. That's the idea out here. So weak companies should go down. But if you protect weak companies, if the government steps in and buys out, bails out weak companies, now you don't have a market economy. You have a suspect economy where you have public sector companies, which are government owned, coexisting with private sector companies, which people own, stockholders own. Government owns General Motors. And the only way General Motors could build cars is for the government to give warranties on cars. The government should have no business warranting cars. It's not the job of the government. We don't pay them to warranty cars. And you're letting a weaker company survive. And that's what happened with, why shouldn't Toyota take it over, or Hyundai, or whoever the heck wants to take it over? Why shouldn't they? Citigroup, $20 billion company being loaned $45 billion of taxpayers' money? Who makes this decision? Taxpayers? This is our hard-earned money. How were we not consulted in making this decision? Why shouldn't we just pay $20 billion and buy it out? Who are we helping out here? Shareholders or people or the public? And it's public funds. So who are we helping when we bailed out Citibank or Bank of America? We should have let J.P. Morgan and Wells Fargo emerge as the stronger banks. That's what the market would have said. Why should we bail them out? Is the public being helped or the shareholders being helped? Why was AIG bailed out? $25 billion owing to Goldman Sachs, because so Goldman Sachs would go down too. So these are not economic decisions, they're political decisions. Because if GM goes down, there are 5 million votes affiliated with GM. Political suicide to let it go down. Right? But it's not an economic decision. It's a social, political decision. That's a new economy. We have public sector enterprises now. So what happened in the Great Dipper? Basic things now. People were lying about financials. Financial analysts, financial, investment brokers, investment underwriters. Everyone was lying about financials of companies then as they were now. No difference. You go back and study what happened in the Great Depression, you'll see. And the 33 Act was all about disclosure, compliance. And so was the 40s Act. But none of these acts, if you look at the Series 7 or the CFP, it doesn't prepare you to invest and manage someone's money. That's not competence. You look at the Series 7, it's a joke for investments. It's a good for compliance, but it's a joke for investment. They just ask you definitions. So is the CFP. The CF is closer. But it was the same problem then, it's the same problem now. We are going to get a bigger government because of the reform of the new public, whatever the reform brings us, and I'll talk about that in a moment. Which means we are going to get back less money per tax dollar of our hard-earned tax dollar because we have to pay more people. The Reform Act now, CEO compensation issue. It's in your face. If I'm a really good CEO of a bank, do I want to work for a bank where the government tells me how much I'll get paid for the best work I will do? Would you? Suppose you are a top CEO. No way. No way. Why should I work bank where the government tells me how much I'll earn for my best work? Personal utility. So that's hello markets in your face. We don't want the good people running banks. What kind of a thing is that? Markets didn't fail. How do you control the behavior of CEOs? By doing this? No, they were at fault. But this is not the way. You're punishing markets, not CEOs. You're driving the best people out of one of the most important industries in the economy, the financial sector. This notional principle and counterparty risk. I know you guys don't get into, most of you don't get into this stuff. This is the credit default swap, notional principle in swaps, $50 trillion of notional principle in swaps. They're saying that you can't do it in the OTC market. That's like telling Citibank or J.P. Morgan or UBS that they're big boys, but they can't look after themselves. they need the government to look after them. Why not? If these big boys want to play with $50 trillion of notional is like funny money principle. It's only in books. But if a company like AIG goes down, it's real money. It's not funny money anymore. And that's counterparty risk. And it's in like, not 50 trillion, it's like $500 trillion notional principle in the swap market. $500 trillion. Scary, right? Scary. But who are these big boys? What are they doing? When you say, all right, you can't do it, you're basically saying market isn't functioning. Is that true? Is that true? Because you regulate the market if the market fails, a market failure, like a monopoly. That's a market failure. We know that. So you regulate. Utilities cannot charge more than 12.5% markup. We understand that. But where has the market failed here? And what are you regulating? Consumer Protection Agency. Imagine this. What you are selling to your client. That someone is going to, the government is going to protect the client from you. So understand the suitability. Next time if this goes through, you sell a product or not sell a product to a client, your client can say, why didn't you sell me the product? Or why did you sell me this product? They'll take it to the government who will say, my experts are better than your experts. Is it going to make it more efficient for customers? Consumer protection, how complex are these instruments that we buy and sell, like say indexed annuity? How complex is an indexed annuity? Someone's going to tell someone that it's not suitable. I can put an indexed annuity together. You know that. Some of you have seen my presentation. So government is going to protect it, trying to tell someone that this is not suitable for your client? What can you not promise? Again, bigger government. Same as last time. All right. Marks. Whole new set of, this is the big problem with that last question. How do you advise your clients today? How do you advise your clients today? Because the benchmarks are changing. Are they changing? Let's look at them. Whole new set. Macroeconomic, GDP, unemployment, inflation. Rates on stocks. I've talked about expected returns and on stocks and stuff. On bonds, other financial securities. On real securities, like real estate, commodities, currencies. On volatility. What are the benchmarks? How are they changing? Here's inflation rates. And you can see since 1950, we haven't had a deflation. Now we do have a deflation. After 50 years, change in benchmark. We thought inflation was standard. We had a big dip, like in the 50s. Look at the 70s and 80s, what happened. Remember the roaring 70s, that's the star mark. Look at what inflation did in the 70s. This is the 10-year Treasury notes, all right? This is the risk-free rate, government 10-year Treasury note, from which most financial securities are priced, like a bond, like most mortgages, all bonds, financial security, even stocks. The risk premium is over the risk-free rate. So this is the 10-year risk-free rate. Look what happened in the 70s and 80s. Does this look startling to you or not? And these are 10-year averages. I averaged monthly returns over each 10-year rate, and I plotted the average 10-year rates. Look what it looks like. How stark is this? Look what the next one looks like. Unemployment rates. Natural rate of unemployment in the U.S. has been 5% for the longest of times. That's the natural, that's Milton Friedman's theory, and it's been like that. Look what it is late. Is it changing? How long is it going to be up there at 10%? Is it temporary? You guys all know it's not. It's permanent. Permanent is how much? I don't know. 5 years? 10 years? It's not temporary. How long is it going to take for us to get these people back in the jobs? And for the young people to find jobs because the older people can't retire. Look again what happened in the 70s. That spike. Can't get away from what happened in the 70s. Savings rate, this is the exercise that, David showed. Look at the savings rate. Look at what happened in the savings. This is the baby boomer generation. People born between 45 and 64. All right? Remember that. were the peak from the 1980s through the 2010. That's the peak of the imperial cycle of the US. Our generations before us, generations after us, will not have the lifestyle we had during these last 30 years. That's a peak. That's a peak. We already started seeing it's shrinking. We had wonderful times. That's all right. Long cycles, 80 years, 100 years. Doesn't mean we are going to be poor tomorrow. But that's an issue. If you are 60 years old, when you make a decision, borrow more and spend more, what if you had a decision to make where you could spend today? Let's say the government can spend today and ease your burden, but it'll screw up your children's happiness. Their lifestyles really go down. People are proposing spending more on deficit financing because if you're 60 years old, your life is pretty much gone. You're going to be dead before the bad effects of that deficit comes to haunt us. It's your kids. It's our kids and our grandkids. What decision will we make? Our welfare or our kids' welfare? If we had saved, it was our kids' welfare along with ours. If we spend, it's only our welfare. This is the saving, and I talked about it. The fear of this crisis turned us around saying, oh my gosh, what have we done? Let's at least get back at least 6 months' income before we spend anything. Here's the VIX index. It's very interesting, the VIX index. I want you guys to sort of start thinking this. This is the volatility, daily volatility. So look at two things. Those stars, one is the 70s. No, sorry, one is the dot-com boom, and one is the 2000 dot-com bust, and one is the 2008 bust. The last two big busts, 1998, 99, dot-com boom and bust, and the real estate boom and bust. Look what happened in the volatility. In between, this is from 1990, you see periods where volatility is really low. In the stock market, this is S&P, the VIX index, right? Volatility index. And look at the S&P returns. So whenever the volatility goes down, S&P and stocks do well. As volatility goes up, we are in trouble. Volatility is a good indicator to follow. And look how much daily volatility indicators gone up. And if you do a trend line, in the last 2 years, it's jumped up 20-30%, the volatility. And as volatility goes up, markets go down. S&P volatility. So now volatility has gone up, expected return has gone down. Benchmarks. What are we going to do? So going back to your questions, how do we advise clients? You educate them. You look at 30, 40 years. This is the best we can do. We'll have to keep it as safe as we can today. Even if you have a 25, 30-year plan, 3 business cycles, what does that mean to me? Can I manage business cycles, 30 years of someone's portfolio? What does it take? What should I put? What's the asset allocation should be to look at that? All right, I got that. So we know that from the 2008, one thing we know, we are part of the world. We are no more isolated. We cannot be, even if we wanted to be. This 2008 crisis hit everyone. We got hit the hardest, by the way. And of course, some European countries got nearly as bad as us. But countries like China and India and Brazil, they fared much better. They were all affected, but their dependence on us, if it starts going down, our dependence on them will go up, and that's a problem. And I'll put more pictures. I've got a couple more slides to still come into this presentation of what's happening everywhere in the world, which has an economic consequence. All right, and it's like Back to the Future. What do I say? Fighting the Taliban or G20 or British Petroleum, all sorts of things. New things happening. I thought this was a hoot. How desperate are people around the world? This is how desperate. I can't stop laughing. Norfolk, Virginia had their first piracy-related conviction in 150 years. These guys are this desperate. They are so impoverished. These 3 Somali pirates on that canoe, you see that picture? In the evening, they couldn't recognize this U.S. warship. And they with their grenade launchers. And they thought they would hijack this Saudi ship and make $2 million ransom. and they attack this warship, the US of A warship with, the rocket science. These three guys opened fire on this ship, and this guy got caught, taken to the US, and they admitted to attacking the US warship. Just imagine how desperate do you have to be to think you can, just attack anyone and take over the ship and think you'll get 2 million. And in this case, yeah, it's oops, huge oops. But that's the way the world is right now. It's like people are really desperate everywhere in the world. A lot of Americans are going overseas for jobs. That's another, it's going to show up in this thing. I wanted to let you know that. Search it in some of the mainstream press. There are opportunities for us overseas. We should be getting them right now. That's a way for reducing our unemployment, one way. Why should everyone keep coming here? We should also go out and make money outside. And we are doing it, but we need to do more. Pessimistic bubble. This is a new chatter I heard. The high price level of bonds, I'm sure some of you know that bonds you can't touch them. They're so expensive. This guy, I think in the New York Times, called it a pessimistic bubble. Imagine, because he said people are being too cautious about their lifetime savings. So this high price of bonds is a pessimistic bubble because people are too cautious with their money? Call it a bubble? It's not a bubble. It's a reasonable reaction. It is scary, and in this fear, I want to be in government bonds. I want to be in some good agency bonds and some muni bonds and, build America bonds. Safest places I can be right now, in the greenback maybe. What's wrong with that? He's saying this is because it's a bubble. It's a pessimistic bubble. Never heard of a pessimistic bubble till now. But this is what we are hearing. Right now, one of the best things to invest in is the tips. Even though we have deflation, at least you'll get your principal back. In cash, if it turns around and there's inflation, in cash, if it keeps on deflation, of course you'll lose. But if it turns around, in cash you'll lose money. In deflation you'll make money. One of the best things are like these government tips and sovereign bonds. Build America bonds, I thought was a great deal. Now they've stopped those. Very little to invest in. And I'm saying, I don't have an answer for you. If you are looking at me for answers, I don't know. All right. Thank you much. And that's the end of the so let's go back and erase the slide. All right. That is my presentation next month and a little bit more. I'm going to turn off my talk and I want to hear your impressions, please, anyone. You can type, you can talk, as you please. Agree, disagree, and if you agree, disagree, that's okay. If you agree or disagree and you talk about it, start part of this chat of how it's related to what we're doing. It is related to what we're doing. Get it into the discussions of whether it's anchoring. For example, in the last 10 years, S&P has made 0% return, right? So anchoring, is that, how does it affect us? In 10 years' time, will we make 0% from stocks or 0% from us? All right, Jacob.
Thank you. Yeah, very good presentation. What I was wondering about when we talked about kind of the notion of too big to fail, and I mean, and from your point, it's kind of saying we must fail for it to normally process. I guess my thinking is are we protecting ourselves enough from the by stopping it now, are we protecting ourselves in the short term but necessarily making bigger impacts for the long term, is what you're feeling?
Very, very good question. Absolutely. If we start shoring up our own economy through savings and reasonable investment, we will delay the process of handing over our empire to the Chinese. That's part of the slides coming up. Absolutely. We have 70, 80, 100 years at least for this economy to be fully down and the new economy, China will come up in 30, 40 years, will still be a power. We can delay it or we can hit it. Right now we are hastening it, handing it over, saying we are tired of being at the top. You're absolutely right. There are things we can do to slow this down. And, in my last, if you read my column in the Journal of Financial Services Professional, it's about the government. Is the government too big to fail? What's a lean, mean government? That's what it is. Yeah, even including the government, there's no such thing as too big to fail. Then you won't get the strong companies surviving, which means we won't get the value as consumers in a market economy. Yes, please.